Hi, everyone. This is Keith Schneider, the other half of Mish, and I'm going to be filling in for her today. And we're going to be going through a whole bunch of different charts. My style is a little bit different than Mish, so I hope you can tolerate it. So let's get going. There's some interesting things going on. And what I want to do this week is really do a top-down analysis and really focus on the highlights. So just so you see, Mish and I are the founders, along with Jeff Bish, of MarketGauge.com. And we have two plugins that are going to be sold, and as also it can be included in the new ACP charting platform. We love charts. We've been doing them for decades. We started on the floor doing point and figure charts and certainly have evolved to where we are today, a lot more sophisticated, a lot more capability, and we've developed two proprietary indicators. And I'm going to show you them today, and we're going to go through them, through all the different charts, the top-down view of the markets, and some big themes that are evolving all through the eyes of our different indicators. So the first thing I'm going to mention here is that the first indicator, right, is the market gauge real motion. So what we like to do at Market Gauge is really look at the price action in three different ways, right? The first, the top part of the chart here is a classic simple candlestick chart, and we have a 50 and a 200-day moving average. Right now you can see here the green is the 200 and the 50 is the blue. Down here, we're looking at our real motion indicator. And what that does, it looks at the momentum. Oftentimes, not all the time, momentum precedes price. So what we like to do is we use a 200-day moving average as a baseline. We can change that. And then we use moving averages of the movement beyond that baseline. And we do two of them. So you've got a 50-day of real motion, which is the blue, and you've got the 200-day. And I like to compare what the real motion is telling us in terms of the moving averages compared to what the underlying price action is. So that is our real motion gauge. The next thing that I like to use is understanding relative price performance. So basically, it's looking at one instrument versus another. Today, we're going to compare a whole bunch of instruments against the S&P, which is our core benchmark index. Okay, so the bottom chart here, right, is in fact the what we call our triple play indicator. And this part of it here is looking at the relative performance. And again, it also has a couple of different moving averages and a Bollinger Band as well. Okay, so with that, hold on, okay. So now with that, we're going to look at some really key intermarket relationships today. And what's interesting is before the when the market closed today, we've got this risk gauge that we do for Market Gauge website. But here you can see, right, the risk gauge looks at 5 key intermarket relationships. We're going to look at a couple of them today. So the first one we're going to look at is XLU, which is the utility index or the utility ETF. And this is obviously right now what we're looking at the moment. And we're looking at it compared to the S&P. Now, one of the reasons why we like to look at utilities versus the S&P is it really gives you an appetite for risk on and risk off, right? So at the moment, what's interesting, even as we're sitting on close to new highs for the year, what's interesting, if you take a look here, the bottom chart, you can see we're starting to show strength over starting in the mid part of July of utilities over the S&P. So that's sort of interesting, and it goes totally counter to what is happening in the market, right? The market is basically, you know, in a powerful up move, and yet our risk indicator here, so this is a chart of utilities. Our risk indicator is basically showing that utilities is outperforming. You can see over here, at least on a shorter term basis, is overperforming or outperforming the S&P 500. And it's also, on top of that, breaking out above its 200-day moving average. Now, obviously, we got some earnings reports here on the close, all favorable. Facebook, Amazon, Google, all these have reported well. So it'll be interesting to see how this plays out. Now, the other thing I want to mention is that our real motion indicator on utilities is coming up against long-term resistance, which is the 200-day of real motion. So that's sort of corresponding with what's happening in the underlying price chart. And since price often shows price leadership often is confirmed early on by the real motion, what's happening here, what's interesting is the utilities are showing it's hit the upper band in real motion. So maybe with this extra strength here, we're going to get a flip and the S&P will resume leadership. But again, this is an important relationship to follow. At the moment, as of the close, it's showing basically risk off because utilities on a relative basis outperform. Now, let's take a look at another chart, right? We like to look at gold versus the S&P as well. So one thing you can see is, well, actually, let's go through here, and we can see what's happening with the real motion indicator. So real motion, you can see we've got some of the strongest momentum that we've had in quite some time. And actually, what I'm going to do is move this to a weekly chart. And if you take a look at it, the last time we had this type of momentum really took place back in 2012, right? Now, we're not nearly where we were, right, as the market was peaking out in gold in late 2011. So momentum here, really strong. There's no divergence or lack of leadership here in this particular indicator. Now, the thing that's most interesting is if you take a look at gold versus the S&P, you can see on our price performance, what we call our triple play indicator, you've got a scenario where we're really breaking out on a longer term basis on these weekly charts, is that the gold is outperforming the S&P. So strong momentum, incredible price action, taking out all-time new highs. But here's the kicker. If you look at where the ratio was between the S&P and gold at the peak, right? Literally, it was triple. So gold on a relative basis is still coming out, as you can see, of this long-term base here, and has a lot of room to reach on a relative basis where the S&P was trading. In fact, if prices remain where they are, there's no reason, right, in the S&P. Let's assume that the S&P is sort of stable at these levels. Gold, if it hit its levels back where it was in 2011 on a relative basis, could be triple the price. And if you look at it, this is one long, massive base that it is breaking out of. So with that, could we get a correction? Certainly, this is really strong momentum. I wouldn't be surprised to see a potential test, even back to where it was before this massive breakout, or at least some sort of correction of this massive rally. But I expect over the longer term that, in fact, gold will continue and could be much, much higher. Could go to double the price. A lot of it is going to be based on just where the S&P is trading, obviously, because these ratios depend on the price levels of two different ETFs here. So there you have it. This massive base on a ratio basis is saying that gold should be much, much higher. In fact, it's just really, even with this move to record prices, on a relative basis, we're cheap in gold. Okay, so with that, also, what's most interesting is gold is definitely a risk-off indicator. Now, there are times, certainly, and as you see recently, where inflationary pressures could push gold up and stocks as well. So at some point, there becomes a divergence from the two. So at the moment, it's looking like gold can still gather lots of steam, and both S&P and gold can go up at the same time, but gold should continue to gain on a relative basis versus the S&P. And in fact, the S&P could actually find some important resistance, and gold could still continue and not even be overpriced relative to the S&P. Now, the other thing I want to take a look at is the relationship. So these are two really important risk-on, risk-off indicators. And what's interesting is, despite the market going up, you have the strength in gold and utilities, which are risk-off. Now, let's take a look at bonds, because comparing stocks to bonds is also important, right? Risk-off, traditionally, people get nervous, go to bonds, right? So right now, at the moment, on a longer term basis here, well, actually, this is on a weekly. Let's go back to the daily chart. And you're going to see a couple of things. Interesting, definitely a little bit more of a mixed read. However, one thing you can see is, in terms of price movement, we're really looking pretty good here, right? Where today we ended up attacking the recent swing high that was set in April, right over here. So we're breaching that important level. This spike high here looks like what we're going to be in for, a possible attack on the all-time highs. Now, what's interesting is that at the moment, TLTs underperforming the S&P, so that is more of a risk-on indication, despite this overall strength, right? Because we had this sell-off here down to June. We're just getting back up here. So net situation in bonds is giving us much more of a mixed scenario based on these charts here. But you know what? This is what I want to do is take a look with a little more detail here. And let's hang on for 1 second. And okay, now up. And forgive me because I'm not quite the expert I prefer to be. And okay. So at the moment, just want to take a read here. Yeah, at the moment, TLTs actually are outperforming the S&P. It was hard to see, but you can see here this red line, which is the shorter term measure here of the moving average of this ratio. And you can see here that we're actually over the last week or so, week and a half or so, bonds outperforming the S&P. Also interesting to note that we've got a scenario where we have another risk-off indication. So with that, strong performance both in price. The price chart now, we're in what we call a bullish market phase because we're trading over the 50-day moving average in price, the 50s over the 200, and the slope is strong on both. So bonds definitely in gear, and for the moment outperforming the S&P, another risk-off indication. Okay, let's move on to a couple more charts. Okay, let's see. So we looked at gold. All right. So I'm getting a lot of questions from some institutional players and about value versus growth. Isn't it time that value stocks should be performing well at this stage of where we are? So if we take a look at it, VTV is the Vanguard Value Fund. So what's interesting, right, is you can see here that number one, as opposed to the S&P itself, look at where the chart is here. We are still in a what I would call a decent recovery phase. Why? Last price in value stocks here, the group of value stocks as measured by Vanguard's Value Fund, we're sitting under the 200-day moving average and just above the 50, but that's a recovery phase. So are we doing better? Yes, but when you take a look at growth, you're going to see a tremendous difference. The other thing is you can see here momentum is basically running about where the underlying price is. So there's no real divergence. There's a little extra strength. You can see we are trading right around the 200-day moving average. And in fact, you're just straddling it where in this case you're a bit under on price. So with that, the way I'm reading this is you've got, if you get a breakout over the 200-day moving average, on an absolute basis, value may be okay to play. But if you're looking at the theme of growth versus value, one thing you can see here is that it's really not doing well at all. And if we go, let's take a look at this whole idea of growth versus value and just what's happening. And you can see on the weekly charts, right? Let's go back and hang on. Let's see here, 2017. And I mean, this theme of value versus the S&P, you can see we've really trailed off here. And this is going back, quite some time. So the value stocks here really since the beginning part of 2019 really falling apart. Now, let's take a look at growth. So, wow, right? So growth stocks, you can see, are in a parabolic move up. So moving back to the dailies, right? The big theme of should we get into value stocks versus growth, you really can't compare the two. Growth is still really, really strong. And so, status quo, right? So you can see here, right, 50-day of the growth, right? This is Vanguard Growth ETF, 50 over the 200, and in fact, the price over that as well. Now, what's interesting is if you look at the momentum here, right, as we've made new highs, momentum has also made new highs as well, right? In March, we made a high, right, before the crash. And in fact, we've now made a new high and momentum is confirming. So there's no divergence in the underlying price action on growth. And on a relative basis here, compared to the S&P, you can see that the outperformance here, growth is outperforming the S&P index, which in itself is still quite strong. Okay, so let's compare the S&P versus IWM. So now this is a completely different theme. We're looking at different investing themes. We looked at key intermarket relationships that are showing us that there's some stress and there's a difference between the price action, right, and the appetite for risk, with the exception of the growth stocks are still leading the market up. Now, in themes of looking at market capitalization, what's interesting is that IWM has really been a laggard, right? IWM, small cap stocks. So if we take a look here, right, we could see, right, in 2018, we peaked, hold on here. All right, sorry about all this movement. Hey, stay still. Okay, so, sorry about that. Okay, so one thing you can see is we peaked out in 2019, had this really nasty drop off. I mean, it was over 40%, maybe even close to 50% drop. And we've had a decent recovery, but it's not even close to attacking the all-time highs. However, one thing you can see down here on a relative basis, we're sort of flirting with this declining relative strength measurement with our proprietary indicator. And if we get any stronger here, that's going to be a positive sign that maybe the IWM is going to pick up some potential leadership, at least on a shorter term basis. So it'll be interesting to see. Now, we did have a bunch of reports come out, Facebook, Amazon, and Google, and they were all really on fire. So it's going to be interesting to see what this ratio does tomorrow, and if in fact these big gaps at the moment that seem apparent for tomorrow will continue. So with that, IWM improving, potentially coiling and breaking out, and it is above its 200-day moving average on pure price. We definitely want to see both the 50 and the 200-day hold. Okay, so that's a theme there. The other two things in terms of sectors, I'm going to do this quick, I'm starting to run out of time. If you take a look at semiconductors, you can't really argue with this. So the leading sector in the market right now, semiconductors. Now, what's interesting is even though semis have made new highs, on a momentum basis, it's sort of not keeping up. As you can see here, right, on our real motion, which is measuring momentum, the early part of the year, right, the momentum was pretty strong. And even though we're on new highs here, we still have not been able to get to the same level of momentum. However, at least on this move up here, this shorter term move up, we have kept up. So I would say in terms of momentum, shorter term, we're in gear. Longer term, you're getting a divergence from the highs that were put in March to where we are now. But we really need to see the momentum fail under the 200-day of real motion. So that's that first graph. In terms of relative performance, semiconductors still leading the charge up. Okay, so that's pretty much it for now. As you can see, in conclusion, we've got some of the intermarket risk gauges flashing red. However, price performance still in gear. The leading themes, semiconductors, growth stocks, still playing leadership. And there's a potential shift here in IWM, but we'll see what happens. We have to let the market tell us. All right. Hope this all helps. See you soon, and good luck with your trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.